My name is Jason J. Hamilton. I'm the founder of Keep It Simple Financial Planning. We provide financial planning and investment management services. And today we're going to talk about securing your future. And we're going to talk about a guide to smarter retirement investments. But this is really going to be a general investing workshop that's meant to cover the scope of the brand new investor to a little bit more advanced investor. And I really want to address a few of the biggest questions that most people are having, and maybe why they don't invest, or maybe why they're delaying investing, or maybe why they're nervous about investing right now with all the things going on in the world. So we're going to jump right into that and have a little conversation here around this subject. So hopefully you find it very insightful today, and I really think it's going to be good, and I'm really looking forward to going over this with you today. So as always, if you can let me know where you're tuning in from, please go ahead and drop that in the chat. And if you have any questions, we'll make time for Q&A as well around this. So this is all very, very important stuff, but we're going to do our best to get through it as soon as we can and as efficiently as possible. So let's just jump right in here. So why should you invest? Most people will say it's to grow their wealth. They want to invest their money so it should grow so that they can maintain their lifestyle, goods and services that they like to do today, and maintain their purchasing power. And really the big thing is purchasing power, because there is this little thing that you may be aware of, this I word called inflation. It was very interesting. I was doing a workshop in a high school not too long ago, and I asked them if they knew about investing and what investing was. And not very many people turned up their, put up their hands. But when I said, well, what do you know about money? What do you know about finances? They said inflation, right? So inflation is something that everybody knows about today. And think about how much you might have paid for your first car or house versus your last car or house. These are things that, it's not in your control or my control necessarily. A lot of it's based on government spending, right? At the end of the day, that's what a big part of it is. And as you know, interest rates are going absolutely bonkers right now because the Federal Reserve is trying to bring down inflation to the 2% target level. So rates just went up again, another 0.25%. Many people are expecting that this is going to be the tip where things really stop going up from here, but who knows? And what I want you to think about is who cares? Because you're going to invest in a way that I'm going to share with you. And if you just do it this way and you don't freak out, you're overall going to have a better experience. So let's talk a little bit about this. All right. So inflation, what it does is it erodes the real purchasing power of your wealth. So let's take a look here at a quart of milk. Okay. Back in 1920, a quart of milk cost 17 cents, okay? 17 cents for 1 quart of milk. By 1970, for 17 cents, you got 2 cups of milk. And as of last year, you got 11 tablespoons of milk for that same price. So inflation is an absolutely real thing, and it's not going to ever stop. To be honest, our system is based on inflation, and we want things because, if you have investments, for example, if you own a home, for example, well, the price is going to go up. Ideally, in the future, you can sell it for more than you paid for it and make a profit, right? So there are good things about inflation, but doesn't mean everything is good. But there's something else that I think maybe some of you are a little more concerned about, okay? So I took this today. So what we're seeing here is the national debt clock, okay? So if you look at the national debt here, this is as of today, okay? We're over $31 trillion, okay? So the national debt is a real problem. And if you didn't know, the government has put you in debt for $94,791. That's how much how much debt we have per citizen, right? So if we ever wanted to pay off our debt, that's what we're going to have to do. And by the way, our debt is something that's never going to be paid off. So it's not something that I really want you to worry about, that our debt is getting paid off. I do want you to worry about how fast it's growing. It's probably not going to ever stop growing, but the pace that it grows is or could be a real problem, okay? But there are 3 ways to get out of this, okay? First way is we can grow GDP. If we grow GDP, we can potentially, grow our way out of debt. And that's what we've done over time, by the way. Number 2 is increase revenue. So what does that mean? So if someone can guess what increasing revenue means, I would love to hear that in the comments. But what it means is the government needs to increase taxes, right? So more taxes and fees, I should say. So that's the second way to get out of it, and that's going to be on you and me. And the third way is to decrease spending, all right? So decreasing spending is a third option. And it's like, well, is the government ever going to actually decrease spending? It sure doesn't seem like it right now. So, that's something that we may end up doing. We'll see how this thing goes right now. We're having some debt ceiling talks at this point, and it seems like we're at a stalemate. I know that's a big concern of people, but again, neither you or I can do anything much about that. So one thing that I do want to remind you of is that inflation doesn't necessarily mean that like the stock market is going to have bad returns, and quite the opposite, by the way. So many people wonder like if stock returns will suffer if inflation keeps rising. But here's the good news is that usually stocks do quite well in relation to inflation. So what we're seeing here, these red dots are what inflation was each year. And then the green is the S&P 500 1-year real return. So if you look over the years, this is the red dots here, okay? And as you know, in 2021, we had some massive inflation here. But these green returns are the S&P, okay? So since 1992, which is the time frame I have here, 1992 to end of 2021, so it's about 20 years, 1-year stock returns have fluctuated wildly. But their weakest returns actually occur when inflation is low. So look at this. Some of the weakest returns occur when inflation is low. So, in 23 out of the past 30 years, we saw positive returns even after adjusting for inflation. So over the period I'm showing you here, the S&P 500 posted an average annualized return of 8.1% after adjusting for inflation. So, and the annualized inflation adjusted return of US stocks is 7.3% when you go all the way back to 1926. So history shows that stocks tend to outpace inflation over time. So this can be a very valuable reminder for those of you that are stressing out a little bit about inflation. I don't want you to stress out too much about inflation. Okay, we have other problems, but inflation is not the main one when it comes to your market returns that you need to be concerned about. Okay. So another thing that I hear people say a lot of times, especially for you new investors, and I invited a lot of new investors to come watch this workshop today. I really hope you're watching if you're relatively new to investing, because you're going to get quite a big education here. And I should let you know, folks, I'm going to try to get this done in about 45 minutes to an hour, but it's going to be, somewhere around there. But that's the goal, is to really give you everything you need to know in that amount of time. So, but investing does mean taking risk. So people do say that all the time, but what you have to remember is not investing means taking risks too. So if you consider the long-term threat of inflation and, you just want to put all under your mattress, for example, if you don't grow your money, you may not be able to afford the things that you want to afford in the future, right? So how do people grow their wealth? Well, one of the best ways, and one of the ways that I personally believe in the most, is letting the stock markets work for you. Okay. So most people, most of the retirees that I work with, most of the ones that have hit $1 million net worth in their lifetime, in one lifetime, have generally two sources of wealth: their home and their market investments. Most people, what they did, they put somewhere between 10 to 20 or more % of their money into tax advantage accounts like 401ks, IRAs, Roth IRAs, and even taxable brokerage accounts. I don't know anybody who just saved $1 million in cash. I have no clients like that. So this chart here shows you the documented growth of wealth over time. And what it's showing you here is, if you put $1 in back in 1926, what that dollar would have turned into by the end of 2021. So, inflation would have made that dollar $16, you could say, worth of purchasing power. A treasury bill would have been $22. A government bond would have been $194. The U.S. large cap index, which is the S&P 500, would have been $14,076, and the U.S. small cap index would have been $37,486. So as you can see here, the markets have rewarded people that have invested for the long term. But on the other side of the coin, T-bills, which would be like the U.S. Treasury bills there you're seeing at $22, they have barely covered inflation, because inflation would have turned that dollar into $16. You take $16 to buy what it took to buy a dollar back in 1926. So U.S. stock returns have far exceeded inflation and significantly outperformed bonds. So, having your money in the markets, especially during times like this, is hard to do, but these are the people that win over time because they don't get scared and they don't give up on the markets when things get a little nervous, or a little nerve-wracking, I could say. So if you're somebody who's feeling very nervous right now and you have all this stuff going on, it's still a good time to keep some of your money in the markets. I really don't recommend you take everything out, okay? Because you're going to miss things, and we're going to talk about that in a second. But one thing I want you to take away is that there is a very large world of opportunities. Many people just invest in the S&P 500, and that's all they do. And if you took that, that's about, 40-ish% or so of the global market, and the U.S. stock market is about 59%. So even if you just invest in the U.S. stock market, you're only investing in 59% of the investable market. So this is something here that, you might be missing out on some opportunities. And this last year, or this last quarter, I should say, actually the last year as well, international has done better than the U.S. So that's something I really want you to think about. And when you get to the bond side of the market, the U.S. here is about 40%. And then you have, countries like Japan that are 13, that little tiny island's 13%. So, you want to make sure that you're not only investing in the U.S. markets, and you're making sure you take advantage of other opportunities as well. So how do many people invest? Let's think about how a lot of people attempt to grow their wealth over time, and this is all common stuff, okay? I see this all the time, right? First thing they do is they try to predict the future, okay? They talk about these winning systems. You see these Facebook ads and TikTok right now, folks. For those of you that are on here, I know most of you are, usually older, okay? My audience is generally around the retirement age, but if you are somebody that's on TikTok, it is unbelievable how bad the advice is on there. Okay. So it's very scary what's going on. But again, to each their own. And this is why you need to do your own research before you start investing. But I hear things like this all the time. Oh, my friend has a winning system for picking stocks. This sector will continue to advance through the next year. The market is primed for a retreat, like things are going to go bad. These are things you hear in the media. People act on impulse, right? So for those of you right now that are stressed about this current debt situation, if your investments are not positioned to get through a time like this, we're going to talk about what to do in this workshop, but you need to think about that because you shouldn't be freaking out about anything short term like that. And then on the other side, everyone's making money. I want a piece of action quote there. If you're within 5 to 7 years of retirement, you really should be thinking about getting to a place where you're not quite as aggressive and you're thinking about preservation of your assets, because what you don't want to do is get to retirement and then you have a bad market and now you have to keep working appropriately. So we're going to talk about that as well. And here's my, for those of you that are Jim Cramer fans, I heard it on the news, sell this, buy that. There's actually an ETF that they call the inverse Jim Cramer, okay? And if you would have followed that ETF, you would have done a lot better than the markets would have done overall if you just do the opposite of what he says. So these hot tips from your neighbors or your friends that work in industry, I really want you to calm all that noise, because that is not the way to invest, and I really don't recommend that. And there's much better ways to do things, which we're going to talk about. So the thing that happens a lot of times though is you just get bombarded by these media articles everywhere you go, and now with cell phones, it's in your pocket, it's just in your ads, it's just all over the place, and you can hear things about it's easy to get rich. That simple plan to have it all. That statement, because I use that. I do like having a simple plan, but there's nothing that I would ever want to do outside of if we have a global World War type of thing where we are now sitting here and we had, a nuclear bomb drop somewhere, then maybe at that point, okay, what's going to be worth a lot of money at that point is bullets, guns, and bottled water. But even still, even if that happened, it's more than likely not going to be the whole world. And it's more than likely that Google's still going to be, helping you send emails. It's more than likely that Facebook's still going to be a social network that's going to help you, connect with other people. And it's more than likely that Amazon is still going to be delivering packages potentially somehow, whether it's through drones or robots or some other thing. But it doesn't mean that the stock markets are going to go to zero, okay? So, people that are tempted to act on these media messages should really remember that the media is selling entertainment and they're selling commercials, not financial advice. So is investing risky, and what is the best way to invest? Okay, so let's talk about this a little bit because I want to give you some data, okay? Here we go. So is investing risky? Let me know what you think. Right? Put that in the comments while I'm doing this. Is investing risky? The short answer is yes, it's somewhat risky, but it doesn't mean you need to not invest at all. No, I don't think that's the case. So let's talk about the S&P 500. So on any particular day, the S&P 500 may or may not make money. Okay? So on any particular day, 53% of the time, you're going to have a positive, and 47% of the time, you're going to have a negative, right? That's on a day-to-day. So for those of you that watch the markets on a daily basis, stop it because there's no point to do this, okay? And then we go to a month. And if we invest our money in the S&P, then on average, you are going to, for any particular month over time, you're going to have 63% chance of having a positive return and 37% chance of having a negative return, okay? So positive, negative, positive, negative. But then we go over the course of a year, and over the course of a year, things look a little better, okay? On any particular year, 75% of the time, you're gonna have a positive, and 25% of the time, it's gonna be negative, okay? So you can expect that. 1 in 4 years in the S&P are probably gonna have a negative return. So if you know that, and you plan for it, it makes things a lot less risky, or at least a lot less challenging to accept, you could say. So, how do you make money in the markets? Okay, let's talk about that. So the old way of making money was such. You would here if you say this box here is the investable universe of stocks, okay? If this box is the investable universe of stocks, then you'd have a few stocks here, and it was all about picking the right ones. This is the market timers, okay? Pick the right ones. That's how, people used to do it. And this is what they sold over and over, but we don't really need to do that anymore. There were better inventions created, right? We had mutual funds and ETFs and index funds. So the new way to invest, if you take this as a whole investable universe, is what you want to do is you want to own a little bit of everything, okay? Own the markets, and what do you think I'm going to say? Be patient. Okay, so we're going away from picking the right ones to owning the market and being patient. This is really important because if you're not somebody who's patient and you're somebody who is going to make irrational decisions at all the wrong times, then you really shouldn't be investing, or you need to have somebody help you, okay? And this is where, hey, and people like me come in. An investment advisor that can help guide you, can coach you to help you from making those horrible decisions that potentially could just completely ruin your whole financial picture, right? So that is not what we want to do. We don't want to be timing the market. We want to own the market, and we want to be patient. Okay, so let's dive a little bit more into this here. Okay, so what does it look like to own the market? Well, here's a few examples. This is an example. If you put $1 in the S&P 500, okay, back in 1926, at the end of 2022, after a market downturn, it was higher in 2021, but at the end of 2022, that dollar still would have turned into $11,527. Pretty amazing. But look at this. So many people only invest in the S&P 500, but they don't always understand that there are other asset classes. Again, we're going to go into more of this today, but there are other asset classes besides the S&P that have returned better over time. Doesn't mean that they're less volatile or that they're better or worse. They're just different. But in this case, we have the small cap index from 1928 to 22, and $1 turned into $41,204. And I think I said 22. The growth of $1 invested in the small cap index from 1928 to 2022 turned into $41,204. And now when we go to the growth of the small cap value index from 1928 to 2022, that turned into $128,147. That's $1 that turned into $128,147. So folks, this is why, for those of you that are new, for those of you that aren't investing, for those of you that are sitting on a big pile of cash somewhere that are afraid, you got to think long term, because what is going to happen, this could be you, by the way. If you put $1 in 1926 and into a 1 month treasury bill, so you just kept it safe, that dollar, as of last year, turned into $22, okay? So your money needs to grow. You need to grow your wealth. And for those of you that came from, lower income backgrounds that may not have the experience and the knowledge to do this kind of stuff, get the help, okay? Reach out to me. We have some new programs to help out people that are just getting started. So please reach out. And for those of you that are older here, if you have children or grandchildren that need some help with this, as long as they're 18, ideally at least working, 25 or 30, we have some wonderful new programs that I'm releasing, and I'll talk more about that later. But we want to get more people investing, because in reality, if we have more people investing, everyone's going to be better off, okay? So let's really revisit this graph a little bit here, okay? So at the end of 2021, the US was 60% of the global stock market, okay? So as a whole, that's 4,013 companies. So if you're only investing in the US large cap index, which would be the S&P 500, you're only getting 500 companies there. Not great. And as you saw a second ago, the small cap has outperformed over time. Again, it doesn't always happen, but it's happened there. But what we're forgetting about is there is a lot more companies in this world that we can invest in, and actually about 18,500 more between the developed markets, excluding US, and emerging markets. So over 18,000 more companies that we could potentially invest in over time. And these are not companies that you haven't heard of, by the way. Have you heard of Toyota and Sony? Those are Japanese companies, right? Have you heard of Nestle? That's a Swiss company. So there's a lot more companies in this world that you can invest in. So only investing in the S&P 500 and missing out on the global investments, that's going to be something that will possibly cause you a problem down the road. So let's talk about recessions, right? So for those of you that are, I hear it all the time too. The recession's coming, the recession's coming. My opinion is we're already in here, by the way. So if you look at this graph, this is an example of the S&P 500 index from January 2007 to December 2010. When we look back at the data, this is where the recession happened, okay? So 2007 to somewhere at the end of 2009. This is where the recession was announced. So market is already basically almost all the way down. So the recession was announced, and then it, hit its bottom, and then it started coming back up this way here. But this is when the end of the recession was announced after 2010, after the market had done most of its recovery already, or a big chunk of its recovery already. So this is the problem with listening to media, and why, if you have a good investment strategy, you stay globally invested, and you rebalance as needed, you're going to have a much better experience over time than you would if you just, one, put it in one asset class, but two, listen to the media. Okay, so I'm bashing on the media a lot today, and that's okay. It is what it is. Because I feel like right now, there's a lot of hype and fear going on, and I'm seeing it from just like all angles, like, all kinds of media. I mean, it's really in a lot of places. So if you can take these principles and bring them into your world of investing, I really think you're going to be better off. Does that mean the market's not going to have volatility anymore? No, it doesn't mean that. But what it means is over time, you're more likely to do better. And we're going to continue to talk about this. So if you look at this graph here, what you're seeing is all of the recessions in the last century, okay? We've had 15 recessions in the last century. And in 11 of those instances, stock returns were positive 2 years after the recession began. So we have the months here, so 24 months. And in all of these recessions here, stock returns were positive 2 years after the recession began. So 11 out of 15, right? And the average annualized return after the onset of the recession was 7.8%, right? So if you put in 10% at the top of the market when, the economy was at its highest point, and then we went to a recession, 2 years later, your account would have, on average, would have been $11,937. So you would have made almost 20%, over that next 2 years. So the recession thing is, I'm not saying it's not real. I'm not saying things aren't going to happen. I have a bigger concern about AI, a much bigger concern, I should say, about AI. Artificial intelligence is going to be the craziest thing since the internet was invented, since cars were invented. I mean, it's going to be insane. So this is something I would be more concerned about than people losing their jobs, or companies going to zero, I should say. I'm more worried about people losing their jobs that aren't really specialized jobs. So if I were you folks, I would really start learning about AI, and a couple cool things to look into are something called ChatGPT. Just start playing with it. You can write blogs, you can write books, you can write movie scripts, you can write songs, you can ask it anything, you can write code for computers. I mean, it's pretty amazing. But just start to learn and play with these tools because they're going to be very useful and they're going to be in your life at some point. I mean, for those of you that are retiring, you might get out alive, but for the rest of us that have a while, we need to learn to adapt, not run away from this. Okay. So let's talk about the cost of trying to time the market. So what's going to happen if you think you're somebody that is just, and I've talked to, I'll say at least half a dozen people in the last few months about this. They said, oh, I don't want to put my money in the markets because the market's too crazy right now. It's too volatile. I don't want to invest. I'm going to keep my money in cash. I said, okay, well, what would it look like if you missed some of the shortest or some of the best periods of returns when the market was volatile or the market was down? Well, if you would have put $1,000 in back in 1997 through 2021, that $1,000, if you just didn't take it out, you just left in the S&P 500, that $1,000 would have turned into $10,367. Okay. What if you missed the single best week? Just 1 week, the best week of returns. Now you're down to 86.52. You missed the best month, you're down to 82.79. You missed the best 3 months, now you're down to 73.08. And the best 6 months, you're down from $10,000 to $6,728. So folks, again, for those of you that are new investors, this is what I want you to take away from this slide. Once your money's in the markets, never ever take it out. Your only options are to rebalance your accounts, or unless you're ready to turn that into income and if you're in retirement. But if you try to time the market and go in and out all the time, this is probably the result you're going to get, if not worse, by the way. All right. So what this visual is going to show you is that to be a long-term investor, you need to be comfortable with volatility, right? And if you're not comfortable, this is where having a coach in your corner comes into play. Vanguard does a study, and it's called Dalbar. There's a company named Dalbar that does a study, but Vanguard publishes this as well each year. Investments, which everybody knows, loves, and trusts, says that the value of a financial advisor for the average investor on increased returns on average is going to be about 3% average per year. That's what you're going to get more by having a good investment advisor guiding you. And that's a multiple of things: being properly invested, optimizing for taxes, optimizing for behavior, and at the end of the day, not making any huge bad decisions. But one thing I don't want to sugarcoat for you, because I'm showing you all these big numbers and all these returns, is it doesn't mean there's not going to be volatility, okay? So if you look at these, what this here is the bull and the bear market, okay? So these are bull markets, these are bear markets. We're currently in a little bit of a bear market right now. It's recovered a bit, but that's currently where we're at now. But from 1926 through 2021, the S&P experienced 17 bear markets, or a fall of at least 20% from the previous peak. So when you have a 20% fall from the previous peak, that's what a bear market is, right? So we experienced that last year, by the way. So declines range from 21% to 80% across an average length of around 10 months. So the average declines are around 10 months. That's pretty normal with market ups and downs. But on the upside, there were 18 bull markets. So there are 18 total here of the bull markets, and the gains of at least 20% from a previous trough, right? So 18 bull markets where the gains were at least 20% from a previous trough. And I think, potentially this year or next year, we're going to be seeing some good gains. That's just what I think, but who knows? The bull markets average 55 months in length, and the advances range from 21% to 936% return from the prior down. So when you look at this all viewed together, from a high level, it's very clear that the equities reward the discipline, because look at the downsides and then look at the upsides, right? So investing in equities is something that I truly believe, not everybody, but most everybody should be doing. If you're somebody that really can't stomach this, then, maybe it's not for you. But for anybody that wants to be wealthy, you should have a portion of all of your income going into equities from everything that you make, right? And that's something that I very much so believe that, right? So, but these ups and downs are unpredictable. So the goal is to get a properly diversified portfolio and then don't do anything don't do anything stupid. Like, don't pull your money out at the wrong time and don't make a mistake. All right. So I've covered a lot here on the history of the markets, hopefully overcoming some of your biggest concerns about the markets overall. So let's talk about, where to start, okay? Where most people should start. Right. The first thing I want you to understand is that there is 3 stages of investment planning. And there's one stage that I would say maybe 90% of people going into retirement are making a mistake. They're making a very potentially critical error by missing this one stage, right? So stage 1 is accumulation, right? So accumulation is when you're saving money. That's when you're working, you're saving money, you're contributing to your 401ks, your Roth IRAs. And during this time, and I call this, 10 years plus until retirement, it's very okay to have a growth or an aggressive growth type of allocation. It's okay to have a high equity proportion of your portfolio. Nothing wrong with that at all because you have 10 years to go. Once you get below that 10-year mark, you should really be thinking about, taking a different approach. And this is the mistake that most people make, or the stage I should say that most people miss. It's a preservation stage. So 5 to 10 years before retirement, you want to start moving to a moderate or a growth in income type of allocation. And ideally, you want to start putting aside at least a couple years worth of very, very safe assets so that if you were to retire and the market's down, you're not going to have to extend your working career because you had too much in equities. And remember when I talked about that greedy or everyone else is making money type of statement in the earlier part of the presentation? This is where I see a lot of people they get really greedy towards the end of their retirement because they think they're going to miss out. But look what happened last year in 2022. Can anybody here be honest and say, hey, I wanted to retire in 2022, but I didn't because the markets took a dump, right? How many people can say that honestly? Because I know there's a lot, right? So that's stage number 2. And then stage number 3 is your distribution stage. Okay, so in your distribution stage, you want to be more conservative, maybe some growth assets, definitely, but you want to have growth in income, right? Because you want to be providing income for yourself. You want to make sure you have enough safe money, but you got to make sure that your money lasts. So you do need some growth allocation, on the back end of that portfolio. So here's how I like to think about it. 3 simple buckets, okay? This is what I do for pretty much all my clients, whether you're young and you're just beginning investor. I have folks that are in their 30s and 40s that are investing with me. We do the same thing as I do for people that are going to retirement. The only difference is how much money is in each of these buckets, okay? So what we call these buckets are now, soon, and later, or you can also call them safe, moderate, and growth. But everybody should have money in these 3 buckets. It's just a matter of how much. If you're somebody who is 32 years old, well, then you probably only need your emergency fund and really safe money, right? And so that's something you can put into like a high yield savings account potentially. Right now they're paying over 4.5% at this point. It's a great place to put that money. You could put it into some short-term bonds. That could be something that could be good. But if you're somebody near retirement or in retirement, you want to be thinking about 0 to 5 years of money in this safe bucket. For some people, they need 10 because they're very, very low risk tolerance, but 0 to 5 is going to be a good number for about 80+% of the people that I ever speak with. So this is money you also want to have for any sort of near-term expenses. So if you're going to buy a house, let's say in 2 or 3 years, I don't recommend investing this money. It's hard to say that because I'm a high risk type of person. So I did invest some of the money I was going to be buying a house with, and it worked out. Okay, so it can work out. But my guidance and my advice to you is to be conservative, because if you're not somebody that can recover from that and feel comfortable with that, you really don't want to be investing any money you need in the next couple of years, right? So from there, anybody we don't need over 5 years, we want to put in our soon bucket. And our soon bucket is really meant to be that inflation hedge, because inflation, as we've seen these last couple of years, it could be a very serious thing. On average over time, inflation is around 2 to 3%. It's not a huge deal, so we don't have to be very super risky with this money. But this money, that you need in the next 5 to 10 years or so, this could be something you invest in a more moderate allocation. Okay, so you can put some cash, you can put some bonds, and maybe put a little bit of equities in there, right? So somewhere between 20 to 40% equities is probably an okay amount for money you don't need 5 years from now. But again, please speak with your advisor. I should mention here, everything is for educational purposes and not direct advice. But if you don't need the money for 5 years or more, like I showed you earlier, 1 in 4 years, you're going to have a negative return. But over time, you should do okay in equity markets if you keep some of that money invested. All right, but then bucket 3 is our later bucket. So our later bucket's for 10 years more or more, and this is for the long-term investing. So this is for pretty much anybody, right? Even if you're 30s, 40s, or 50s, you should have money invested very aggressively because you're not going to need it for 10 years or more. If you're somebody who's in retirement now, and you have maybe 10 or 20 or 30 years of retirement left potentially, you do need some money in a growth bucket because, again, inflation is a real thing and you don't want to run out of money on the back end of your retirement. So how much you put into these buckets is all going going to be very individualized. And this is where you need to have a financial plan that helps you understand how much money should you be allocating to each of these 3 buckets. You should be saving some into each of the 3. And then, I did talk about last week in excruciating detail. So if you didn't watch last week's workshop, you should go back. You want to make sure you're investing the money here and here in the most tax efficient way. Okay. And we have pre-tax accounts where you're going to get a tax deduction today. We have tax-free accounts like Roth accounts where you'll pay taxes today, but then it grows forever tax-free. And then we have taxable brokerage accounts that if you put the money in, you pay taxes when you sell and you'll pay a capital gains rate. So we have 3 potential taxable buckets to put money in and 3 potential buckets of time-based money or time-based buckets to put money in. So here, this is where, again, you got to get a good financial plan and get everything laid out that works for you for your particular situation. Okay. Let's go a little bit deeper on the stock market. For those of you that are brand new to investing or those of you that may not be, very seasoned investors, this pretty much sums up the whole stock market in one square. Or actually, I like to say it's like, how many squares is this? 10? I guess, 10. There's some type of, I think it's 14 squares all in, right? If you put everything in. But anyways, we call this a 9 box, okay? Why is it called a 9 box? Because there's 9 boxes, right? So when it comes to stocks, we've talked about this a little bit so far. We talked about large companies, right? So the S&P 500 is a large company index. We've also talked about small companies. The Russell 2000 is a small company index. And then there's some stocks in the middle here. So this is a representation of the Russell 3000. So that's the Russell 2000 plus S&P 500. So it's all the stocks, all the US stocks basically. So if you added up all these numbers, these would add up to 100%, okay? So if you look at the US stock market, it has 3 sizes of companies, right? Small, mid, and large. And then there's 3, you could say, styles of stock. We have value stocks, we have growth stocks, and then there's a blend. Okay, so there's 2. There's value and growth. So we're just going to use value and growth today. And then we're really just going to use large and small today. So value stocks are companies that are considered to be a cheap price based on their future expected cash flows. Growth companies are companies that are expensive, but they're expected to grow quickly. So what that means is you'll pay a high multiple of their earnings when you're buying growth stocks, and value stocks are a lower multiple of their earnings. So but when you look at this 9 box, this is pretty much the whole stock market wrapped up in, one visual here. So, you want to have some money in each of these different areas, but what does this look like at the next level here? So if you took the Russell 3000, which is the total US stock market, and you broke it down and we said, okay, well, what's in this? This is what I don't want you to be scared of investing. I want you to be comfortable investing, because all you're doing when you're buying a index fund is you're buying a basket of different companies that makes it very easy to own a very diversified portfolio versus buying each one of these stocks separately. If you wanted to have a diversified portfolio and you wanted to buy all these separately, it might take you, thousands of dollars, potentially, maybe tens of thousands of dollars to own these companies here. These are just kind of the top holdings in here. But you can buy 1 share of the Russell 3000 in a ETF for maybe $100 at this point. I don't know what it is, maybe $130. And you can own, that'll divide this up for you, and you don't have to do anything. You don't have to manage it. All you do is buy it and hold it and let these companies do their thing. But if you look at what's in the Russell 3000, here are the top companies. The biggest one is Apple, and that's 5.64%. Microsoft is 4.7%. Amazon is 2%. Tesla is 1.4%. And NVIDIA is 1.3%. Alphabet, which is Google, is 1.36%, and so forth. So these are all companies that you more than likely heard of before. So one thing I want you to hopefully walk away from today is investing should not be scary. Investing is something you should feel very comfortable with. It's just a matter of knowing how to start. And again, if you don't know how to start, I'm going to get to that. But I want you to understand that by buying, mutual funds, index funds, or ETFs, you don't have to be a genius. You don't have to be a stock picker. You're somebody who can go out and do this yourself. But if you want to get fancy, then there are ways to potentially outperform, and those are things we talk about as well. But, from a high level, if you just go and buy the total US stock market index fund, and all these big companies have them, Vanguard has one, Schwab has one, Fidelity has one, it's not going to cost you very much, and you can start to invest today in a extremely diversified portfolio, okay? So let's talk about a little bit a difference between the S&P 500 and the Russell 3000. So remember, the Russell 3000 is the whole US stock market, so it contains the S&P 500, but it also has another 2,000 plus companies. But look at the difference between these two when it comes to our 9-box comparison. If you look at the large here and large here, you can see that there's more large in the S&P 500, right? These are all a little bit higher than what we're seeing over here. But the S&P has no small cap, where small cap here, if you own the Russell 3000, there is some small cap there. So this is important because over time, the small cap index has done a little bit better than the large cap, but that's not always the case. And what I'm about to show you here is there's no guarantees or anything that this is going to continue, but this is what we call our dimensions of expected returns. So over enough time, these asset classes are going to return similar to what I'm showing you here. But one thing that you may not know is that there's certain areas of the stock market. So like I mentioned, small cap versus large cap or value stocks versus growth stocks that perform differently. So even though these companies or these ETFs or index funds may be fairly priced, it doesn't mean that different asset classes don't have different expected returns. Okay. So looking at this chart here, if we look at the S&P 500 over time, over almost 100 years, 1928 to 2022, the S&P 500s were returned about 9.85%. The last 10 years, or excuse me, the last 50 years, it's been about 10%. And so very consistently, if you just put your money in the S&P, you can expect a 10% return. But there are some problems that could come up. And again, we're going to address this in just a few minutes here. But look at the small cap index. The small cap index has done about 11.84% over time. So that's almost 2% better. And if you look at global stocks in developed markets and emerging markets, large companies in the developed markets, which is think about companies like Shell Oil, think about Nestle, those type of companies, they've done about 8.9% return over time. And small company, but international, have done about 13.45 over the last 52 years. And when we go to emerging markets, so emerging markets are like Brazil, Russia, India, China. You can think Philippines, Vietnam, those type of countries. The large companies there have done about 8.7, and the small companies have done about 11.49 from 1989 to 2022. So that's 2.79% return. So me personally, when I'm investing money for clients, I'm going to tilt a little bit extra to the small companies, not a ton extra. And by the way, you should not be putting all the money here. And we're going to cover this a little bit more in just a moment, but these are something that you may not have known about. When we go to value companies versus growth companies, okay? This is the thing. There's famous radio personalities that say, just put your money in growth companies and you're going to do better. Well, growth has done 9.28 and value's done 12.52 over time. So that's a 3.25% spread to the positive for value. Again, if you go international, value's done 4.5% better over time, and it's done 5% better over time in emerging markets. Profitability is another metric. I'm going to skip that today because that's a little bit more technical, and this is meant to be somewhat of a general presentation. Okay, so if you're brand new to investing, I really recommend you consider researching target date index funds. Target date index funds are just a really simple way that it's a fund that's designed to automatically adjust its asset allocation over time with the goal of providing a balanced and diversified portfolio. So it's kind of an all-in-one fund. And as you get closer to retirement, it's going to become more conservative for you. So if this is something you want to do on your own, then this is where I recommend you check out, at least do some research there. Some of the benefits here is, number one is simplicity. Very simple, very straightforward. It's a hands-off approach. All you have to do, your only job, is to put as much money as you can in your accounts and just let the fund do its thing. Number two is diversification. The nice thing about target date funds versus an S&P is it's going to invest in a broad range of assets. So you're going to have stocks, bonds, cash. It's going to be globally diversified. And so it's going to spread it out and it's going to minimize that risk for you over time. Number three is it's going to have automatic rebalancing. So again, this is a hands-off thing. So me personally, I have a system that rebalances accounts for my clients because we don't use target date funds. We use individual funds. But if you're doing this on your own or you're just getting started, just go to your 401k and look in there and look for target date fund. And then pick the one that correlates with either an event you have coming up when you need the money, retirement possibly in the future. So for example, if you're born in 1980, you'd pick the 2045 target date index fund. Simple. That's all you got to do. What I don't want you to do is pick that and then pick an S&P 500 fund on top of that. I see this all the time where people will pick a target date index fund and then they'll pick 4 or 5 additional funds trying to quote unquote diversify. And then all they're doing is messing up, their actual diversification. And they're actually concentrating their money and they're adding more risk to their profile without even really realizing it. So if you're somebody who's going to do a target date index fund, this is meant to be an all-in-one fund. You do not need to have any other funds. Okay. Number 4 is low cost. And number 5 is professional management. Okay, they have professional management, and that is definitely potentially a good thing if you have no idea what you're doing. So if you don't know what you're doing, targeted index funds, great place to go. If you're more experienced if you're someone who's more experienced and you have some experience in this area, then you might want to consider researching some index funds of different asset classes and building your own portfolio. So here's usnews.com's recommended 10 low-cost index funds or ETFs to consider buying. So they have a Fidelity 500 index fund. There's a BNY Mellon Core Bond Fund, Vanguard Total Stock Market Index Fund. So these these are some options that you might want to consider in investing in. And like this one here, the Vanguard Total World Index, this is the whole globe all in one, right? This one here is a total US stock market. This one here is a US Treasury, so that's your bonds. This one here is more of a dividend focused fund. And this one here is just as another S&P fund. So these are all ones you can consider, right? It might be something you want to consider to build your own if you want to be a little fancier, okay? So now I'm going to lead you. So for those of you that are beginners, okay, that's pretty much what I have for you. For those of you that are a little more advanced, that want to invest in a way that's a little more technical, I'm going to bring you into my world and teach you a little bit about the way I invest and around the markets and how we can tilt your portfolios and we can create a portfolio towards areas with higher expected return in the markets so that you can ideally generate better returns over time. Can I guarantee that? No, but history has proven that so far that it would have worked out quite well for you. Okay. So before we get into that, let's talk a little bit about the differing approaches to investing. The first one is, just somebody's trying to time the market. You're trying to identify mispriced securities. So this is the old Warren Buffett strategy where he would just try to find companies that were underpriced. He learned this from Benjamin Graham. And so this is a strategy that used to work a lot more back in the day. But now with so much information being out there, it's some crazy number, like $385 billion in stocks are bought and sold every single day. So the amount of information that's out there, it makes it very, very difficult to find mispriced stocks anymore. And this whole idea of undervalued is really just something that is very challenging. And then the big thing is you're going to be trading stocks. So you're going to have higher expenses, trading costs, and risks. So you're adding more costs and more risk. So after costs, this is why index funds have been so popular, because after costs, it's very difficult to be a stock trader and actually outpace an index. It's very, very difficult. So I really don't recommend this at all. Okay, so what we're doing here is, they're looking for buy and sell signals, right? So the red would be the sell signals, the green would be the buy signals, and this would just lead to a lot of turnover, excessive cost, very inefficient way to invest. And unless you're a professional trader, and even the professional traders, by the way, 90+% of them don't outpace the S&P 500. So what's the point? There's really no point to do that. Okay. Here's number 2, indexing. Indexing offers a number of investment benefits over a conventional approach. So if you just buy broad-based indexes like I was teaching you there, you just buy index funds like the S&P 500, or you buy the Russell 3000, and then you buy the total international stock markets, and you just own those for 20 or 30 years, you're going to be fine. By doing that, you're going to have no problems. You're going to have lower fees and a more transparent investment process. But the problem with this is that there's a commercial index provider that determines the stocks or bonds that need to be held in that portfolio, okay? And that firm publishes a list, usually annually or semi-annually, which contains all the stocks composing that index or the benchmark. So the manager, whoever's managing that index fund, has to do their best to closely track that benchmark, but the rigid construction, it works against the strategy because most index fund managers are judged by their ability to closely track the index that they're tracking. So by the way, you cannot invest directly into index. You're going to invest in an index fund, and when you buy an index fund, there's going to be a fee. And in like Vanguard funds, it's like 0.08 or something like that, or 0.1. Same thing with Fidelity and Schwab. But the main problems with this approach is that you have a loss of control, a trading disadvantage, and style drift. Okay, and a couple of things to think about are what happened when Ukraine was invaded by Russia. The index funds weren't able to take those funds out of the index right away. So what an index fund is trying to do is match the returns of a commercial benchmark. So it's going to hold the securities, and the index manager does not start with the whole market, but with the list of stocks published by the index provider. So the manager holds this basket of stocks in an attempt to match or closely replicate that list. And then the investment strategy is defined by the commercial index provider. They don't have any sort of ability to make any tweaks to this. So there's actually a really big trading disadvantage to this. And when that new list is released, the managers must buy and sell at the same time to keep their portfolios and returns in line with the index. So this updating process is known as rebalancing or index reconstitution. And everybody knows what the index fund is holding and when the index fund manager is going to rebalance. So that provider has basically shown their cards to the marketplace, and that fund manager will have to trade with urgency along with the other managers to follow the index. So basically, they're going to pay the highest trading cost possible because they have to trade on a certain day. And so that puts them in a big trading disadvantage and usually at higher costs. The second thing here is you get style drift, okay? So if you have a particular index, so let's say we're trying to keep things in a small cap index, right? Here's your index list. And remember, small cap outperforms large cap over time generally. So your small cap index list, it started with everything inside this box here, but between that 6-month or that 12-month period, companies grow and companies change. And so then they get out of the index. And so if you're trying to have a properly managed strategy where you're trying to keep your small cap in small cap because you know small cap generally outperforms large cap, well, this style drift can lead to problems for you. So as new information is incorporated into the market prices and securities start to exhibit different characteristics, the index portfolio can move away from its target universe or asset class. So this is referred to as style drift. Okay, so this is what's called style drift, and it happens in indices between reconstitution dates, and this leaves you as the investor to hold the stocks, and you may not want to own them. And by the way, this happens when things like I said, when Russia invaded Ukraine. If you had an international index, they may not have taken those stocks out, right away, and they didn't, by the way, which is why some of the funds did worse than some of the managed funds. That's actually something that happened this last year. Okay, so here's an alternative approach, and this is the way that we approach it. So the way we approach is using funds that are looking at the insights about the markets and returns from an academic research perspective, and then we're going to structure our portfolios along the dimensions of expected returns, and our goal is to add value by implementing research, portfolio management, and trading. Okay, so we apply a different investment approach. It's informed by financial science and the view that market prices reflect all available information. And we also believe that different securities can have different expected returns. So being guided by this approach looks to academic research first to gain insight into the dimensions that drive those expected returns, and then integrates that knowledge into strategies designed to be implemented to add value in competitive markets. And I think this is going to be more and more valuable over time because the index fund universe has just gotten so big that I just think there has to be some sort of change coming up sometime in the near future. So rather than viewing the market in terms of an individual stocks and bonds, an investment manager can define the market along these dimensions of expected returns to identify areas or groups that have similar or relevant characteristics. And then this approach, relying on academic research, we can do internal testing to identify these dimensions, which then point to differences in expected returns. So if you take this as your whole market here, and you just put that as a standard market index, what we're going to do is we're going to tilt a portfolio towards areas with higher expected return. So if you look at this chart here, this going from yellow to blue is going toward higher expected returns. So if you think about like an ice tray, that you fill up an ice tray and then you tilt it sideways, and what happens? Some of that water is going to go into different of those trays. So that's how we're going to manipulate the portfolios. And research has shown that some markets do have higher expected returns than others. So we're going to tilt a portfolio towards that area. And in the stock market, the dimensions are size, like I mentioned earlier, small cap versus large cap. So small caps generally outperform large cap. Relative price, so that's value versus growth. And then profitability, that's the third one. So high profitability companies generally outperform low profitability companies. So this is how we're going to tilt a portfolio to provide extra value, ideally to give you as an investor higher expected returns. All right, so how do we apply this to practical investing? There's three areas. Research. We're going to start with research, and we're going to use all the information in current market prices and fundamental data to identify systematic differences in expected returns among those securities. Then we're going to design your portfolio with the target dimensions of expected returns while considering the interactions among those premiums. So we want to make sure that we're staying diversified, we're keeping costs in check. That's really important. And then the third thing is there's going to be a daily managed trading process that's going to make sure your portfolios are going to stay in line and that they don't get too far out of line, and that recharacterization doesn't need to happen once every 6 months. It can happen on a daily basis, and we can use cash flows and dividends and things like that to rebalance appropriately to lower costs over time of that trading. So going back to what I was speaking about when that commercial index gets put out for an index fund, here's what's going to happen with the index funds when they reconstitute and they retrade and bounce back to whatever the commercial index tells them. There's going to be, 40 days before, not a lot of trading going on. And then on the day of trading, it's going to go absolutely crazy. And so you're generally going to pay the highest cost because you have trading volume that goes up in a very, very short amount of time. And when you're doing that, that causes you as an investor to pay more costs. All in, index funds are still very, very inexpensive, but over time, and depending on which index you're looking at, S&P versus small cap versus international, there could be some things that over time add more value by not trading on that particular day when you're able to have more of a flexible process and keep your portfolio balanced to the areas of higher expected return. And so this is the way I want you to think about it. This flexible trading process allows you to, pick and choose when the right time is for you you to make the purchase of that particular company versus only when the index fund provider is going to tell you when that's happening. So for example, if you're shopping for a car, you may, if you only have one option, you're going to pay the highest price for that option. But if you're flexible and you can wait or get different kinds of cars, you're going to probably get the best option for you depending on whatever the market's doing. Very similar with stock prices. Stock prices change quite a bit throughout the day. So by being able to have a managed process, and then along with everything else going on in the world, whether it be the bank crisis, whether it be Russia invading Ukraine, the managed process can help tilt away from companies that are not doing well, that are going out of business, so that over time, ideally we're going to deliver a better return for you. So let's dive a little bit deeper into this. Okay, so as we talked about, here are our dimensions of expected returns. First of all, the market premium. I think we can all agree that stock markets outperform bond markets. We talked about that. What you may not have known is small companies generally outperform large companies, value companies generally outperform growth companies, and I'm going to talk about this now. High profitability companies generally outperform low profitability companies. And this one's one that's very difficult to find a fund that you can invest in. You could probably find value, you could probably find small cap, but high profitability is one that's much more difficult. But as we talked about here, in all areas of the world, so in US stocks, international developed markets, and emerging markets, which is the whole globe, these premiums show up across the board over long periods of time. So if you're tilting your portfolio a little bit towards each of these areas, then generally you would expect a higher expected returns, over time. But the hard part is there's no necessary, there's not a guarantee that this is going to happen in any particular year. So when you look at these premiums on a yearly basis, you can see that, they're going to be quite, looking at here is when the blue shows up, that means it was a positive. And when the red shows up, that means it was a negative. So the top one here is the market, the S&P 500 versus T-bills. So as you can see, there's a lot more blue than red, but there's definitely red years. The one below here, this is our small cap premium. So again, we have periods where small cap is down, and then there's periods where small cap is up. Same thing with value and same thing with profitability. This is on an annual basis. So on an annual basis, it's very hard to predict this stuff. And this is the same here in developed markets and international, and the same here in emerging markets. So again, year to year, very, very difficult to predict. So when we look at, this chart, we're looking at the annual performance of the U.S. market versus T-bills since 1928. The blue bars are showing the years which the U.S. market did an average return above T-bills, and the red bars show when it did less than T-bills. So on average, the market premium is very positive. You see a lot more blue than red. Same here around the world. This is in the small cap premium and also in the value versus growth premium. And same thing here in the profitability premium, right? So more blue than red. But what I want you to notice is that over time, these premiums show up a lot more prominently. Okay. So what we're seeing here is a rolling 5-year period of these premiums. So each of these bars is a 5-year rolling period. As you can see, there are times where we have red and red, but then a lot of times we'll have some things balance out with blue and blue. But if you look at 5-year rolling periods, you see a lot more blue than red in pretty much all these areas. And when you see a little bit of red here, like let's say small cap is underperforming, the next decade it's significantly outperformed. And profitability over the course of 5-year rolling periods has been a very consistent premium. This is in the US markets. When we go to international developed, similar here. A lot more blue than red over 5-year periods. And again, doesn't mean there's not going to be some red, like value's done bad here in recent times, but profitability's done great. Small cap's been a little bit of a positive, and the market's premium has been positive as well. Okay, and then this is emerging markets. Again, similar here, a lot more blue than red. All right, so let's go a little further out here, and let's look at 10 years. Okay. So 10 years out, it's very, very likely. You can see here's the market versus the T-bill. So this means when the market had a positive return. So early 1930s, market was negative, but then it was positive for the next, 40 plus years, had a few years of negative returns, and then it was positive again from 1980 to 2005 over 10-year periods, couple bad years, and then it's been positive, ever since, overall over 10-year periods, okay? So 10-year rolling periods are really important because this is what I'm trying to get at with you with, if you invest money for 10 years or more, it's very likely that you're going to be positive. And as long as you're invested globally, there hasn't really been any 10-year periods when you're properly diversified where you would have lost money with a global allocation. So hopefully you're finding this interesting, okay? And this is something you may not have known, but I wanted to dive into this with you today. Here is our international markets over 10-year periods, a lot more blue than red, and our emerging markets over 10-year periods, a lot more blue than red, okay? So when we look over 10-year periods, you can see here that the blue bars are indicating the years in which the U.S. market did an average return above T-bills, so a positive premium. The red bars stars or when there was a negative return by the markets. So despite the higher performance or the higher frequency of the positive premiums, this outperformance is not 100% consistent. So we need to make sure that we're, again, diversifying properly, for our goals and for our time periods. When we go to small cap, our small cap premium, as you can see here, there's times where small cap is down for a while, but then, prior it was up for a long time, and the same thing, it was down. So these are not 100% predictable, which is why we need to be investing for the long term and making sure we're looking at it that way. Look at the value premium. It's been positive for almost 1940, a couple of years that were bad there, but through 2010. It had a bad decade or so, and then now it's been positive so far, I believe, since at the end of 2022. I could be off on that, but I know it was positive the first month and the second month, but I'm not sure where it is today. I didn't look at that. But over time, the value premium has been very strong. And if we look at the profitability premium, this is a very positive thing that we haven't had a 10-year period since mid-1980s or early 1980s with a negative return for profitability. So if you're not incorporating all of these premiums into your investing, you potentially could have some challenges. So when we look at the last 10 years of premiums of the value premium, I understand that the most recent 10-year here period, it was bad, but it wasn't the worst year by far. And if you look at the amount of positive years versus the amount of negative years, it's a significant difference where, again, there's no guarantees, but the data shows us that over time, generally, we're going to do better by utilizing these premiums. And here's the last 10 years, right? So last 10 years, small's done a little bit worse by about 1.8%. Value's done a little bit worse by about 1.7%, but look at profitability. Did better by 5.27%. This is in the US stocks, I should mention that. International, small did better than large. Value was just a little bit negative, about 0.65%, but profitability was positive 2.3%. Emerging markets was positive 2.38% for small cap, about break even basically for value versus growth, and a positive on the high profitability. So these are very persistent premiums that, again, if you're investing in index funds, you own these companies, but if you're not tilting your portfolios towards these areas of higher expected returns, you could be missing out over time. So to kind of wrap this up here, this is what I really want you to take away, okay? On any particular year, right? On any particular year, this is the US markets. On any particular year, 70% of the time, on a 1-year period, the market's gonna have a positive return. 3 out of 10 years, you're gonna have negative. Any 5-year period, it's going to be about 80% of the time, 79% of the time, you're going to have a positive return. Over a 10-year period, it's going to be 86% of the time, you're going to have a positive return in the US markets. Value versus growth, over 10 years, it's going to be about 79% of the time, 70 over 5, and 60% over 1 year. Small cap versus large cap, 69% over 10 years, 60% over 5 years, and 56% over 1 year. And then profitability is 92% over 10 years, 82 over 5 years, and 66 over 1 year. This is a US markets, okay? So if we're investing for the long term, it's a very good likelihood that we're going to do better by tilting your portfolio towards these areas. Now we go international. 10-year periods, 95% of the time, you're going to be positive. 10-year period for value, 88% of the time, you're going to be positive. 10-year period for small cap, 89% of the time, you're going to be positive, and even 83 for 5 years. And for profitability, it's been 100% so far over 10 years, 94 over 5 years, and 69% over 1 year. And we go to our emerging markets. We have stocks are going to outperform bonds, 84% of the time over 10 years, 69% value is going to beat growth over 10 years, 95% small is going to beat large over 10 years, and 100% of the time profitability is going to be low profitability over 10 years. So folks, this is information that you may not have been exposed to. This is stuff I go over with my clients. This is one of the first conversations we have about how we invest and why we invest this way. I wanted to do my best to provide you some really good education today to help you learn the basics of the stock market, to stop letting these stupid articles, these stupid news channels freak you out, and to consider for yourself, when do you need the money? How much should you be saving? Okay, great. Put it in an allocation that makes sense for you for that particular time period, right? And if this is not something you're comfortable with, this is why we're here, right? You can definitely reach out to us, and I'm going to pull up my website here for you in a moment, but I want you to know that you're not alone. You have someone here you can speak to, and we offer complimentary consultations. And ideally, if you have an advisor, great, go speak to them and have them help you out. But if you don't have somebody, then, reach out to me. I'm happy to speak with you. And we have some spots right now, not only for our retirement clients, but also for our accumulators, okay? So we have a couple new programs that we're going to be releasing very soon. Actually, they're kind of starting basically, but for people that are still in that accumulation phase, where we're going to just do a membership type fee, and we're going to help you with cash flow and investments and with your workplace benefits and making sure you're on track for financial independence, okay? So if you want to schedule your wealth strategy call, you can go to keepitsimplefinancial.com/talk, and you'll find my calendar page there. You'll be led to a couple forms for information, and then you'll be all set to go. It doesn't take very long to schedule that call. And I do have some times available opening up, but we are getting a little bit busier. So I'm going to take a minute here and check questions. So if you have questions, go ahead and pop those in, and I'll do my best to answer those while we are here. And I'll also like to know, did you find this useful? Was it insightful? Did you learn something? Please tell me, what your thoughts are, because I would love to know if you enjoyed this. All right, but let's see if we got some questions here, okay? Okay, this is what I love. So let's go back to this here. Whoever put this said, this has been really good and easy to understand. I appreciate that. That's what my goal. I know towards the end we got into some technical information, okay? I do understand that, but I wanted to go beyond the basics, but hopefully the basics could at least help you feel comfortable. But thank you so much for that comment. I really appreciate that. Okay, so let's see this one here. It's a long one. All right, normally I take a long 10 approach and I don't sweat the everyday stuff. However, since I'm retirement but not planning on drawing Social Security to 70, the potential ceiling fiasco in the stock market has me worried. The media is saying the markets could crash 50%. Yes, it's the media, but the stock markets do react to perceptions, valid or not. So somewhat valid, okay? Because understand is the stock markets are pricing in all known information every single day, right? So things like inflation or things like the national debt, those are already priced into the stock market, right? So could it take a dip? Sure. But whatever the particular beliefs are and whatever the data is telling us could be possible. But whoever put this here, I want you to know that if you follow my 3-bucket strategy and you put 5 years of money aside and you don't have to touch any of your money for at least 5 years, you're going to ride out things like this debt ceiling thing. You're going to ride out things like this inflation thing. So that's what I would say to you if you're sweating it, is to actually properly set up your investment portfolio so that you are allocated appropriately. All right, let's see what else we got here. Okay, very insightful. Probably one of your best trainings yet. Thank you so much. I wanted this to be good. And what I want this to be, folks, if you're in our Facebook groups, we're gonna have this edited and it'll be inside of our Facebook group for you to watch at a later time and really in like good quality. So that's what I'm doing now. I'm having everything edited and put in there because I want when people come in to just get this really good education so they can stop freaking out and make better decisions. But thank you so much for that, whoever said that. I really appreciate that. Sherry said helpful, especially the first part. Thank you, Sherry. I know the second part is a little bit technical, but this is the thing, folks, is like, you can invest on your own, do it on your own, no problem. But I think there's a better way. And if you want to have some assistance and get a little bit more technical and ideally have a better outcome, then that's what I'm here for. But you don't have to do that. All right, so I got a question here. All right, so last one, I think. So good info and thanks. I had planned to stay 80-20 allocation even into retirement. My thought is that I can do this since my stable income stream covers my expenses. Your thoughts? Listen, this is all about risk tolerance, okay? So there are a lot of things that will say, okay, what should your stock allocation be? It should be your age, a 100 minus your age. So if you should be at a 60-40. Or there's some people that say it should be 120 minus your age. So if you're 40 years old, you should be at 80-20. I don't really subscribe to any of that. I subscribe to my bucket philosophy. And so what that means is I'm going to look at how much expenses does my client need in the next 2 to 5 years. Okay, great. We're going to keep that money safe. What are their expenses planning to be the next 5 to 10 years? Okay, great. We're going to keep that money in moderate. And then any money we don't need for 10 years or more, then that can be in growth. And for someone like you, maybe you don't need a lot of money and you can just live off your pension and Social Security. That's a lot of people, by the way. I see that quite a bit. So I think that will probably be fine. My concern for you would be, how are your taxes going to look later down the road? Should you be looking at converting some of that money today to Roth account brackets or lower than when they're higher after 2025, and maybe when you have a required minimum distribution in the future, right? So that's what I would put to you is for your particular situation. But really good question. And I think this is very individualized. And that's why I don't subscribe to anything that's of like the 4% rule. I don't subscribe to 120 minus your age. I don't subscribe to any of that. I subscribe to working with the individual client and helping them design a plan based on their particular goals and needs. So really good question though. If you enjoyed this, folks, please share this with somebody. Please tag somebody you know in this post. If it's inside the Facebook groups, by the way, you're not gonna be able to share it or tag anybody. You have to go to my Facebook page because that's public. The groups are private. But please invite your friends. Invite somebody you know can benefit from this information to come and watch this workshop. And if you're somebody who's watching this and you're saying, Jason, I want some help. I think there's a better way and I want you to help me out with that. And you want to get your whole plan together. You want to look at tax planning, distribution planning like Roth conversions, or when to take money out from which account the best way, how to time your pensions, your Social Securities, and put your whole plan together. Or if you're a young wealth accumulator and you're just like, I don't know what to do, Jason, I need help, go to my website, keepitsimplefinancial.com/talk. It's complimentary, the consultation. And if I can help you, I'll let you know. And if I can't help you, I'm going to let you know that as well. Okay. So folks, that's what I have for you today. Thank you so much. I wish you a wonderful afternoon. We'll see you next time. All right. Talk to you soon. Bye now.